Then, okay. So first step before we begin, um, it's understanding what type of questions will you see in a CAPM chapter. And honestly, under the capital asset pricing model chapter, there are 4 categories of quantitative questions you should expect. Basic formula questions, then beta questions, then alpha questions, then pricing questions. Now, within the first segment, the formula segment, we're going to look at 3 types of sub like categories of questions. Missing variables, so you have to solve for K, RF, beta, the market risk premium. And then we're also going to look at some complicated past exam questions, which will be percentage change in the expected or required rate of return, and then percentage change in the price of a stock. All this related to the formula. Now, within the second segment, which covers beta quantitative questions, there are 5 subsegments that we need to work through. The first one is pretty straightforward. You just got to solve for the portfolio beta. Simply plug it in within the weighted average sum formula, and you'll get your output. The second segment is finding, well, what will be our portfolio's new beta once we decide to purchase a new asset or sell a set of assets, okay? The third subsegment of beta questions would be solving for individual betas. In other words, this would mean that we would require you to solve for a specific beta of an asset within a portfolio. It's pretty interesting stuff. And then the fourth subsegment would be the weight of beta. So figuring out, well, what is the specific weight attributed to one specific stock in this portfolio? And of course, because we are under the capital asset pricing model chapter, we're going to mix some sort of beta action with it. And then the last and fifth subsegment here would be finding the expected return per unit of beta. It's a strange type of question. I've only seen it like a few times, but it's still really important for you to have that exposure because who knows, it may be on your exam. And if not, well, listen, at least you were prepared. Okay. Now, within the third category of quantitative questions under the capital asset pricing model chapter, you would have to simply solve for alpha. Literally a walk in the park. This question has never been hard on any of the exams. And honestly, it doesn't always arise, but it's good to have exposure to it. And that's why it's in the practice problems at the end of this document. And then finally, it would be the pricing category in terms of exam questions you may see. Now, pricing only has one type of subsegment here, one type of question you'll see within this category, and that's figuring out whether an asset is either under, over, or fairly priced. Super easy thing to do, and I'm going to give you a crash course, a 101 on how to do so and do so quickly. Okay. Now, finally, at the bottom of the screen, you do see that there's this comprehensive question subsegment that's actually spanning all 4 categories of quantitative questions. Is because for CAPM, they may actually mix all these topics together, and they may even go further and mix it with previous chapters like equity valuation, time value of money, and portfolio theory. And I gave you exposure to all those types of questions in a complicated fashion at the end of this document. All right. So hopefully this gives you a sense of what to expect, of what will be on your exam for CAPM source of questions. Obviously, we didn't have any examples in front of us right now, but once again, at the end of this document, you have a bunch, 40 questions just for this, okay? In which they've been categorized. So you know exactly what type of question you're practicing for and whether it's a final exam type of question too. So that's awesome stuff. Now, that said, we could actually move on to the next step, which is getting a quick overview of the CAPM formula. And listen, this is probably a gold mine, and you'll need to really understand that it's fairly similar to our formula for the capital allocation line. But this formula for the CAPM will also be our formula for our security market line, okay? This will also be our formula for our security market line. And we're going to look at that in just a second. What I want you to be able to see is that we're solving for the required rate of return on any given stock or portfolio or security. We're really solving for K, which is the required rate of return. And in order for us to solve for K, which once again is the required rate of return, we're going to look at three components, okay? We're going to look at the risk-free rate, which is right here. We're going to look at beta, which is going to be the beta of the asset and or the portfolio. And then we're going to look at the market risk premium. Market risk premium is simply how much return somebody expects to receive on the market portfolio above the risk-free rate of return, okay? Now, is there too much time to be spent on this? No, because there is a video that is 2 hours long on this, and then there are my previous crash courses. But what I would like you to understand is that this formula should be in your cheat sheet, and this formula represents all you need to know about CAPM, and it'll also represent our security market line. Our security market line will be showcased in the next slide. All right. So overall, I'm going to ask you all a funny question. Is this okay? Are we all good with the CAPM formula? Like quick yes or no, just to see that we're alive. Is that okay? Yeah? All right. Cool. So, just straight up stuff. Trying to make this as efficient as possible. Now, I want to give you a little bit of kind of CAPM graph intuition type of stuff. I won't spend too much time on this. The reason why I won't spend too much time on this is one, because I want us to start doing exam questions, but also because there's literally about 50 minutes dedicated to simply understanding what is CAPM graph intuition. And if you haven't already gotten it, just send me a text right now on Messenger. On my Google folder, there's literally a formula sheet that talks just about CAPM graph intuition. So there's a lot of time on that. What I would like to say though is very simple, okay? This formula that we have here, this SML line, okay? So this is obviously the SML, okay? And within our SML, on our x-axis, we have our beta, right? We have our beta. And on our y-axis, we have our expected return, right? Or I guess, my bad, our required rate of return, okay? Which is going to be in percentage. So horizontal axis, we have our betas. Vertical axis, we have our required rate of return expressed in percentages, all right? It's awesome stuff. But what's really interesting, I think we could all agree, is that our security market line seems like literally a straight line. It's a linear function, okay? It's a linear function. And if y'all remember, back in high school, linear functions were expressed by this beautiful, simple formula, okay? They were expressed with y is equal to mx plus b. Do y'all remember this formula back in high school? Y is equal to mx plus b. Quick yes or no in the chat. Okay, the linear function. Why? There's no way we don't remember this. Okay, cool. Because I was like, then I gotta go speak to like the government. If you guys didn't get to see this yet. So yeah, y equals mx plus b, in which we know, right? B is going to be the intercept. X is obviously whatever is on our horizontal axis, and then y is whatever is on our vertical axis, and m would be our slope. Some people, I guess, they call it like the run or something. I forget, but our slope. Okay. And what's awesome is that two things. We've noticed that our security market line is a linear function, and they gave us the formula of the SML. In other words, the formula of CAPM, which once again is right here. What's awesome is that we could actually notice that, I draw it right here, that our CAPM formula is also a linear function. Like it stands also, right? Our CAPM formula also represents y equals mx plus b. Just it's written in a getaway. If you look at this right here, RF is going to be our intercept. It's going to be B. Beta right here, right, is going to be our X. And then ERM minus RF, our market risk premium, is going to be our slope. It's going to be our M, right? If we do the exercise one more time, we notice how X is right here. So beta is going to be our X slider. We notice that whatever output we get is going to give us KI, which is our required rate of return, which is going to be on our y-axis. And then we notice that RF, right, our intercept, is the risk-free rate. So the reason why I took the time to quickly just run through this, and once again, there's like an hour worth of videos on this, is because on past midterms, during fall semesters and winter semesters, so the second midterm, they love to ask multiple choice questions related to the security market line and its graph intuition. For example, and you'll actually see this in this document as well, they'll ask you, what is the slope of the security market line. And by understanding that our CAPM formula is quite literally a linear function under the premise of y is equal to mx plus b, it lets us know and it empowers us to understand, obviously, well, the slope of the SML is the market risk premium. The intercept of the SML is the risk-free rate, right? So this is really important, visualizing it, because on the exam, they may ask you small things like that. Let me ask you all a quick question, put it in the chat. Is the risk-free rate the slope or the intercept of the SML? Is the risk-free rate the slope or the intercept of the SML? Write it in the chat. Is the risk-free rate the slope or the intercept? Amazing, okay? So the higher the intercept of the SML, the smaller the risk-free rate. Is that true or false? The higher the intercept of the SML, the smaller the risk-free rate. Is that true or false? Amazing. So we're on the same page, right? Those are the type of questions that you may see on your exam. It's hilarious. It's literally so easy, but somehow people still mess up the thing. I don't know how. So this is just to give you some quick CAPM graph intuition, and we're doing pretty good on time. All right, cool. Now, another thing that I'd like to share is this notion of beta. What the heck is beta? Okay. Well, a few things. I'll zoom in a little bit. Okay. Just a few things that you could brainstorm on. And once again, there's a bunch of videos that I've posted on this. It's getting kind of funny at this point. But beta, I guess we'll highlight a few points. Beta is another measure of risk, more so systematic risk. But what I want you to understand is that beta is another way to measure risk. However, it measures risk in a very interesting way. And I'm sure you've already seen this already, but this is the formula for beta, okay? In which you're going to have the covariance of one security with the market index. So what this is telling you here is that we're going to assess the covariance of, call it Tesla stock, with the market index, which is stated with M. Okay, so far so good that we're looking at the covariance of a random stock with the market index, with the market portfolio. Is that good? Quick yes or no in the chat. Okay, yeah. So this is what I'm just sharing what we're doing with the covariance thing. And then at the bottom of that, we're going to look at the variance of the market portfolio. So this is going to be the variance of the market portfolio. Okay. So what we're doing now is we're looking at the covariance between one random stock with the market portfolio over the variance of the market portfolio. This is the variance. This is the variance, and this is the standard deviation. So sigma square is equal to variance, and then sigma normal, just sigma, is equal to the standard deviation. Okay. Obviously, there are two ways to write this formula. I would say put both of them on your formula sheet. No worries, no worries. Okay. So just to give you guys a quick refresher, what is the covariance? The covariance assesses how do two different objects or items move in tandem. Okay. So a positive covariance, so a positive relationship, would suggest that if this goes up, this would also go up. Okay. A negative covariance, a negative relationship would suggest that if this item goes up, this item will go down. Okay. That's what the covariance tries to track. So in this example, we're looking at the covariance of Tesla to the market portfolio. Okay. So we're looking at how Tesla will move in relation, or I guess how the market portfolio will move in relation to Tesla, right? How are they moving together? That's what we're trying to assess. Okay. So that's what beta does. It looks at the covariance of something over the covariance of something to the market portfolio over the variance of the market portfolio. Okay, that's what it does. But beta, all right, my last end of my spiel. Beta, sorry, I was trying to make it cute, like a nice little line. There you go. What beta really looks at, some really interesting stuff. Beta looks at that, but I think I'll ask you another question. Sorry, I kind of got I took 2 steps ahead. Can somebody tell me in the chat, what is the beta of the market portfolio? what is the beta of the market portfolio? Y'all should know this. I need everybody in the chat to tell me. I'm not going to look at the chat just yet. Everybody write in the chat, what is the beta of the market portfolio? Okay, beta is equal to 1 for the market portfolio. All right. So if we were to write our formula back, we would have covariance of the market portfolio in relation to the market portfolio over the variance of the market portfolio. So obviously, if the market portfolio and the market portfolio, they're literally the same thing. So if the market portfolio goes up, the market portfolio goes up. The market portfolio goes down, market portfolio goes down, because it's the same thing. Obviously, if I do this, I did this type of thing. Like, you know what I'm saying? Like, it's literally the same thing. So that divided by the variance of the market would literally be equal to 1, because you're assessing the covariance of the same asset over its own variance. So it's like saying 1 divided by 1 will be equal to 1. Or if the variance was like, call it 0.05, well, 0.05 divided by 0.05 gives you 1, okay? So that's why the beta of the market portfolio is equal to 1, because it moves in tandem to itself, such that the covariance is simply the variance, and the variance divided by the variance is equal to 1, okay? So the market portfolio will contribute to the variance, to its own variance at 100%. So that's why beta is equal to 1. Now, let's take a step back. What did I just say? All right? Beta measures in assets contribution to the overall risk of the market. Okay? Now, the market obviously contributes fully to its own variance. Is that clear so far? That a market will contribute fully to its own variance. The market portfolio will contribute fully to its own variance. Say no in the chat if that's clear. The market portfolio will contribute fully to the variance of the market portfolio, right? Say no in the chat if that's clear. Or okay, so let's think about it, right? Let's say 2 yeses, yikes. So let's think about it, right? The covariance of the market portfolio with the market portfolio, all right, will be equal simply to the variance of the market portfolio. That divided by the market portfolio would give you 1. Is that clear so far? Write no in the chat. Exactly, right? If we're looking at the 2 similar items, let's say these 2 are the same thing, okay? Well, if this one goes up, this one will also go up because they're the same thing, right? It's like if I look at myself in the mirror. If I raise my hand in front of the mirror, my hand will also go up, type of thing. So when we're looking at the covariance between 2 of the same thing, well, obviously the relationship will be fully correlated, right? Like they're literally the same thing. You know what I'm saying? They're the same thing. So the variance of the market portfolio in relation to the variance of the market portfolio, well, obviously it'll be nullified. So such that when we say that beta measures an asset's contribution to the overall market, well, for sure the market contributes fully to its own variance, right? Like the market contributes to its own variance, because if I'm the market, I will obviously contribute to the entirety of the market's risk. Like Tesla is only, whoops, sorry about that. And I'll like erase a few things just to make it clearer. But the market is like a whole thing. It's a whole market full of stocks, okay? And we're telling you that if you're measuring the relationship of the market to itself, then obviously, if the market goes up, then the market goes up as well, right? If this is M and this is M, well, if this goes up as well, such that that over its own variance will be equal to 1. That's what I'm trying to tell you, right? Because it's the same thing. And my point being is that because it's the same thing, it's simply equal to 1. And that means that the beta of the market is equal to 1 because it's contributing to 100% to its own variance. Okay. And I won't spend more time on it because I want us to do exam questions and maybe we could talk about it later. But if the beta is smaller than 1, all right, it means that that specific asset is contributing slightly less to the variance of the market portfolio. And if beta is greater than 1, it means that that specific asset is contributing much more to the variance of the market portfolio. We're going to leave it at that just because I want us to do questions, but something to look into, especially if you're going to be taking more complicated classes later. Okay. Now, another thing to understand with, once again, our security market line is that we may need to do something called putting CAPM into practice. So essentially, how do we price assets using CAPM? When we think about it, CAPM stands for the Capital Asset Pricing Model. It's a tool used to find whether a stock is fairly priced, underpriced, or overpriced. Okay, so how do we do that? Well, it's really interesting, and this example is amazing. Okay, let's say that this red dot here, okay, this red dot that we have right here, we're going to call it Tesla's expected return. Okay. And if we kind of check out where it's at, it seems like Tesla's expected return is like 9%. Okay. And it also seems that our security market line seems to say that K, the required rate of return, is, call it 12%. Okay. So if we were to plug this in within our formula in this world, they would say that our K is 12% and our expected return essentially was like 9%. Okay. So far, it would be fair to say that K is bigger than the expected return because K is 12% and the expected return is 9%. So far, are we good? Say yes in the chat. We're looking at Tesla stock and the expected return is 9%. When we plugged our stuff in within our formula, it told us that your K should be 12%. Okay. Well, what does this mean for us? How can we use this to our advantage? Okay. How can we say whether this stock is either fairly priced or underpriced? Okay, so I'm going to erase a few things. How do we say this? Well, there's actually a very logical way to look at this. All right. Once again, don't forget, beta represents market risk. Beta, in other words, it's a proxy to measure risk. Okay. So let me ask you all a question. The higher the beta, the more risky my investment. Is that true or false? The higher the beta, the more risky my investment. Yes or no? True or false? Put it in the chat. The higher the beta, exactly. Okay. I'm going to be annoying and I'm going to say the lower the beta, the smaller the risk. Yes or no? Put yes or no in the chat. Is that yes or no? Exactly. It's true. It's like yes. So beta measures risk. And by plugging this in within our formula, by plugging in beta within our formula, and by plugging in this case, Tesla's beta of call it like 1.4, we get that you would expect to receive 12%, okay? You would expect to receive 12% return for that level of risk, okay? You would expect to receive 12% return for that level of risk. However, you are only receiving 9% in the market. So are you making more return than what you require, or are you making less returns than what you require? If for that level of risk you expect to receive 12%, but you only got 9%, are you making more or less than what you require at that level of risk for Tesla stock? Once again, beta represents the level of risk of an investment. Okay, at a beta of 1.4, which is Tesla's beta, you require 12% return. However, you only got 9% return. So are you receiving more returns, or are you receiving less returns than what you expect? Than what you're supposed to get at that level of risk? I need everybody to write in the chat. Exactly, less, okay? That's a very important key takeaway here. what this is telling us is that anything underneath the SML line, okay, anything underneath the SML line would be considered to be overpriced. Because for the level of risk you're taking, you're making less than what CAPM is telling you should make. All right. But for any point above, all right, any point above the SML line, we would say that something is being actually underpriced. The reason why it's underpriced is because if we use the same example, let's say that Tesla's thingy was like here. Well, this means that for that level of risk, I guess I'll put it like here. This means that under CAPM, for that given level of risk, you're only supposed to get this number here. However, you ended up getting this number here, such that you made more returns than what is required for that level of risk. And for that reason, you are beating the market. And for that reason, the stock is actually underpriced. Okay. Now, quickly, just to give you a little bit more context, if something lies on the SML, it means that it's fairly priced. Fairly priced, and that things are in equilibrium. Now, before we jump into some exam questions, do you guys kind of like understand what's on the screen? Does that make sense? Quick yes or no? Yeah. Underneath the line, it's overpriced because you're making way less than what's required. On the line, you're making exactly what's required. Above the line, you're actually making more than what's required for that level of risk. For that reason, you're dancing, it's underpriced, you made a good investment. You beat the market. Okay. So now we're going to jump into some exam questions just because it's awesome. This is a formula sheet that you could use to your advantage. You can make it your own. Obviously, here we would have our risk-free rate. Here we would have, you know, our ERM, right? And then you could say that over is essentially underpriced. And here you would have overpriced. Then here you'd have fairly priced. And then you could say that the slope is equal. You know, you can make this your own. So kind of a quick way to build a formula sheet. But now I want to jump into some fun stuff. I want to jump into some questions that are awesome. So let's start with a change in K. This is going to be pretty interesting. Let's do that. Let's do that. So we're going to kind of run through them just because I want to give you as much exposure as possible. So ideally, you kind of try to solve it with me, you kind of try to make sense of it. But at the same time, I will try to get the question done so you have some solutions that you could kind of review later. And I'll ask you to interact and you could ask me questions along the way. All right. So you'll see how I solve a question on an exam. So this is an exam question. All right. Let's do it. So let's highlight stuff. Assume that Tesla stock has a beta of 2.11. Okay. And it is in equilibrium, while the required rate of return on the stock is 12.5%. All right. And the market return is 7.5%. Okay. What would be the percentage change in the return on Tesla stock? So we're looking for the percentage change in the return of Tesla stock if the market return increased by 24.62%. Okay. 24.62%. And let's assume that all things remain constant. So already here, there's a lot of information, right? This is an exam question. It's not kind of like clear where you need to go with this. However, when you see, by the way, something, if you were on an exam, when you see the word beta, it's fair to assume that you're going to be dealing with something that's related to CAPM, okay? So if you see beta, you know that you're dealing with something that's related to CAPM. And what's awesome is that under CAPM, you only have one formula to remember. And that formula is quite literally K is equal to RF plus beta times ERM minus RF. Okay? And this is similar to what I said back in the days when we were doing our chapter 5 stuff and our chapter 6 stuff and our chapter 7 stuff, where, listen, if you're dealing with a specific chapter and you understand what are the formulas you are expected to see within that chapter, You don't need to solve for anything else. You just need to identify the variables within the main formula and literally solve for them or find them within your prompt. So if we look at our formula for CAPM, and I'll highlight it in red, there's only 4 things that we're really looking for: the risk-free rate, beta, the return on the market, and if not already given or if you need to solve for it, K. There's quite literally only 4 things that we need to look for. So what you could do is you could actually, we'll start by looking for those variables in our question, and then we're going to see whether we're missing anything or not. Okay. So in this case, we know that our beta is going to be equal to 2.11. All right. So if you were practicing, you would say, oh, all right, I already have my beta. Let me highlight that in yellow. And we know that the required rate of return on the stock, on Tesla, right, our required rate of return is equal to 12.5%. So K is equal to 12.5%. So far, so good, right? We already found like a lot of really good information. And we also know that the market return is 7.5%. Whoops, sorry about that, guys. So we know that the market return is 7.5%. That's awesome stuff as well. So we have ERM. That's awesome. Now we're asking you, what is the percentage change if the market return increased by 24.62%? Okay, so this is telling you what would happen if our ERM increased by, so we increase our ERM by 24.62%. Now, this is interesting stuff because we have our ERM. However, what are we missing within our formula? What are we missing? What's a variable that it didn't give us that maybe could help us moving forward? What's something that they didn't give us within our CAPM formula? Yeah, we're missing RF. RF is the missing variable, right? It's kind of like annoying because now we need to solve for it. We can't do anything unless we know what our RF is, right? Because we want to figure out what would be the percentage change on the required rate of return on Tesla stock. But in order to do so, we would need to have the CAPM formula. But right now, our CAPM formula is actually not complete. So what we could do now, step 1 would be to solve for RF. All right. So we would say, cool. We know that K, once again, is equal to the risk-free rate plus beta times the market risk premium. In this case, we're missing RF. So we know that 0.12.5 is equal to X plus 2.11 times 0.075 minus X. I'm going to ask you all to tell me what is X. In other words, what is our risk-free rate? I'm going to ask all of you all to solve for it. Just to make this more fun, and like this, you could actually try some skills that you would need on your exam, no matter what. I need everybody to try to solve for our friend RF. Everybody try to solve for that. I need one more person to give it a shot. One more person. But I'm liking what I'm seeing. It could be right, could be wrong. You know what? I need one more person to tell me what it is in percentages, just for fun. Okay, amazing stuff. You guys did super solid. Yeah. So that's going to be our answer. It's going to be about 2.99%. Okay. So it would be exactly this. Such that RF, assuming that we don't want to round anything up, we would say that this is equal to RF. So this is really, really, really cool stuff. We are almost done. The next step now is to figure out, well, okay, what would actually happen if we were to increase, okay? If we were to increase our ERM by 24.62%. So what is going to be our ERM if we increase it by 24.62%? So we're going to have ERM prime, okay? And that's going to be simply equal to ERM, the first one, times 1 plus 24.62%. So in other words, ERM prime would be equal to 7.5% times 1.2462. Now I'm going to ask y'all, what is our ERM prime in this case? What is our ERM prime? What is our, our adjusted return on the market? I need one more person to give it. Thank you so much, Kennedy. You're doing amazing. One more person. Okay, cool. Amazing stuff. Yeah. So for the purposes of the question, I'm going to try to round up, to not round up anything, just to make it like, as precise as possible. So our ERM would be equal to this much. Okay, so this would be kind of like step 2, I guess. I'll highlight it in yellow or in red. Step 2, step 1. And we could right now do step 3. Solve for K. Solve for K. And now it's really, really easy because once again, we're just plugging in everything that we have within our formula. And now we're going to solve for our good old friend K, in which we know that K is going to be equal to 2.995% plus 2.11, 9.3465% minus 2.95. Somebody tell me, what is our K? What is our new K in this case? What is our new K in this case for Tesla? What is our new K in this case for Tesla? Amazing, Kennedy. Yes, that is correct. So we're going to have 16.39667. Okay. Now let me ask y'all this. Is the question over? Are we done? Did we find our answer? Yes or no? Where are we at? We did not. Because now we need to find the percentage change in the return on Tesla stock. How do you do that? Very easy stuff. I'll write it at the top, okay? So what you're going to do simply is you're going to do this. Do ERM prime minus ERM over ERM. And this will be equal to I'm gonna need a few people to give it a shot. Yeah, I was looking at my calculator. I was like, really? I must not be able to do math. I was so confused. Okay, so the percentage change though. So Yusra, is it 1.18? That's a percentage change? What is the percentage change? How much did this grow by? What is the answer here? I want the percentage. How much did this grow by objectively? Guys, okay, well, I'll give it to 118.62%. That would be the percentage change in Tesla's required rate of return. Okay, so what we did is we literally did 16.3967 minus 7.5 divided by 7.5. That gives us 1.18622. But the thing is, that's not a percentage. Percentage is literally a percentage. So you do that times 100. That would give you the correct percentage, which is 118.62%. Okay. So far, are we like, did this question make sense? Are we okay with this? Yes or no? Any questions? If you see this on an exam, do you know what to do? Are you empowered to know what to do? Where are we at? Kennedy, where are you at? Tell me if I'm butchering your name. I'm gonna say Mihael. I'm totally sorry if I'm butchering. Okay, thank you. Perfect. Is the question okay? We're feeling all right? Okay. You know what? I'm gonna call you MJ. Call you MJ, like the GOAT, like number 23. You know, MJ like the GOAT, or even one of the best artists of all time. I'll call you MJ like that. I don't disrespect you when I say your name, because I suck at that stuff. But okay, so we're good with the question. This is actually an exam question that's for some reason people don't know what to do because it's ambiguous and it's not the classic thread of stuff you'll see. Now I'm going to move on to a different type of bucket of question, just because I like kind of doing some harder stuff here. So let's do this one. This is going to be a new portfolio beta question and kind of straightforward, TBH, but important nonetheless to kind of walk through. So we're going to do this in 3 seconds. We're going to do this one, then another question, then we're going to move on to market efficiency. Okay, so you're going to have some good introductory vibes to this. Okay, cool. So this is the Kansei University question. Awesome university in Japan. So let's give it a shot. And we'll begin our time now. All right, so new portfolio beta question. We have Kansei University's endowment fund, okay? And this endowment fund holds a portfolio invested in 3 stocks, all right? Those 3 stocks being Toshiba, Sony, and Honda. The portfolio's beta is 1.528, all right? And Toshiba comprises of 28% of the total value of, Kansei University's funds holdings, and it has a beta of 0.37. Now we're asking you, what will be the new portfolio beta? It's very crucial. You hear this term, new portfolio beta. If Kansei, and this is a little typo here, I should remove this. If Kansei sells all of its investments in Toshiba to invest in the risk-free asset. So this is a lot of stuff, but it's actually pretty straightforward. They're going to go invest in the risk-free asset. So what I'm going to highlight here in purple, I just want you to really understand that if you see this on an exam, it should scream at you, like hit you in the face type of thing, that you're dealing with this specific type of question, that you need to use the following framework and the following formula. So if you see something that says new portfolio beta, all right, you need to know that you're going to use the formula for betas. All right, simple as that. There's no other way to cut the bacon. So what is the formula for betas? How do we assess what to do with, betas? It's very simple. The beta of a portfolio, all right, is equal to the weighted sum of all of its individual betas. Now, what does this mean in like actual English? Well, what this means is the following. If you're going to look for the beta of your portfolio, what you're going to do is straightforward. You're just going to do this. The weight of asset A times the beta of asset A plus the weight of asset B, not plus, but more so times the beta of asset B plus trois petits points, 3 little dots, all the way to the weight of asset N, so infinite, times the beta of asset N. It's simply a weighted average sum. It's really easy. It's beautiful. Thank God that they gave you something so easy to work on for your final. Okay. So now what we have is we have 3 different stocks, but we're really talking about one specific stock, the stock of Toshiba. And that's the stock that we're going to eliminate, that we're going to sell in order to invest in a risk-free asset. Still, let's go on and kind of qualify some of the stuff we have in our question. And from there, we'll move forward and really make this super easy. Okay. So far, I think we're doing fine. So the beta of our portfolio is equal to 1.528. And we know that the weight associated to Toshiba is equal to 28%. That's amazing stuff. And we also know that the beta of Toshiba is equal to 0.37. Now we're asking you, what would be, I guess, beta prime, so the beta of the portfolio prime, if we decide to sell 28%, right, of our portfolio in Toshiba to invest in the risk-free? What would happen then? Well, it seems weird because it didn't give us the beta of the risk-free. So I'm gonna ask y'all, what is the beta of the risk-free rate? Can somebody tell me? What is the beta of the risk-free rate? Put that in the chat. What is the beta of the risk-free rate? Kennedy says 0. Okay. Yusra says 0. What about MJ? What you got? What do you got? What do you think it is? What is the beta? Exactly. It's 0. Now, this doesn't mean that the risk-free rate comes with no systematic risk. This means that the risk-free rate does not contribute to the overall market variance. What does that mean? I tried to talk about it before, but that's just something for you to understand. And on an exam, don't make the mistake and don't say that the risk-free rate has no risk. That's false. It has no systematic risk. It's different. Okay, so we know that the beta of the risk-free rate is equal to 0. That's amazing stuff. All right, so we understand that. However, we can't go ahead and solve the question just yet. We actually need to make some basic, get some basic knowledge of what the composition of this portfolio actually is. Because sure, this question gave us, all the information we need on Toshiba, but what about Sony and what about Honda? In other words, what about the rest of our portfolio? We don't have that information yet, right? We don't have anything about that. All that we know, right? If I were to ask you, what is the weight of the rest of our portfolio? Could somebody tell me what is the weight of the rest of our portfolio? That's something that we could figure out already, super quicks. Okay, and what is that? What does that give us? What is the number? I need a number. I need something that I could write down on the screen. Exactly, 72%. Amazing stuff. So we know that. That's pretty cool. So we know that we could call that weight of rest, but we don't have, the beta of that yet. So what we need to do at first to be able to find our new portfolio beta, step one, I'm just going to write it here as being 1, is simply solving for the beta of the remainder of our portfolio, what's left in our portfolio. So what we're going to do is simple. We know that the beta of our portfolio will be equal to the weight of Toshiba times the beta of Toshiba, right? Plus the weight of the remainder times the beta of the remainder. That's going to be the beta of our portfolio, okay? In other words, we're saying that 1.528 is equal to 28% times 0.37 plus, so we can put this in brackets, plus 72% times X, okay? So that's literally all that we're saying. X being the beta of what's left in the portfolio. I would like y'all to tell me, what is our X? In other words, what is the beta of the remainder of our portfolio? And after that, if you have any questions, you can obviously tell me. Yeah, so what is our beta for the remainder of this portfolio? What is it? Yusra has 1.97 or 1.98 if you want to round up. I need one more answer, and then we'll proceed. Amazing. You guys are doing really, really, really well. Okay? That's a testament for two things. One, you guys are working hard, and then two, the material is getting easier. It's stuff that we could grasp, it's stuff that we could actually touch and see. So that's amazing stuff. So we're really happy about that. Okay. So this right here, and I guess I'll highlight it in yellow, is the beta of the remainder of the portfolio. So far, are we feeling okay? Does this make sense to everybody here? Yes or no? Quicks? Just for fun? Okay. Smiles everywhere. We're super stoked. Now let's move on to step two. Step two is fairly quick and fairly easy. Now we're going to solve for the new beta of our portfolio, beta prime. Okay. So beta prime. That's going to be really, really easy. It's going to be the weight of RF times the beta of RF plus the weight of what's remaining of our portfolio times the beta of what's remaining of our portfolio, such that the beta prime will be equal to essentially 28% times 0. That's kind of crazy. Plus the weight of what's left, which is 72%, times 1.97833. So I would like to ask y'all, what is the beta of our portfolio now? There's different ways of going about this, but it's okay. I'm okay with this one. What is our answer? Yeah, that seems about right. Very good job, everybody. I'm going to round it up to just this to make it simple. Okay, so we've got our answer just like that. Pretty straightforward stuff, right? I don't feel like anybody feels scared if they see this on the exam, right? It's pretty straightforward. There's literally two steps that we need to do. Now, key takeaway here is that obviously our portfolio's beta got smaller because now we've invested ourselves in a stock that has literally no beta, right? So that's pretty cool. And once again, on the exam, literally as simple as this. This took us 10 minutes with me asking you questions, taking my time, writing cute. On an exam, you got this done in a minute and a half at most. Before we proceed, do we have any questions? Are we okay? How are we feeling?
Is this like a relatively easy question to what we'll be seeing on our exam?
You'd be surprised. A lot of people mess this one up. I would say, for me, it's extremely easy, but this is an exam question that you will see more often than not.
Okay.
But it's super simple, it's not hard at all. So that's the cool part. So let's see what's the next question that we could do together. Let's do this one, I believe. The question was not clear. I mean, that's why practice helps a lot, because you need to understand that if we're looking for a new portfolio beta, and by the way, questions will never be clear, okay? Questions will never be clear, but in this case, you saw in like highlighted, what will be the new portfolio beta? If they want you to find a new portfolio beta, it's typically us selling a stock that we have right now or us buying a new stock, okay? So that's gonna be the technique, all right? So always think about that. If we have a new portfolio beta question, it's us either buying a stock, all right, or us selling a stock, and now we're trying to figure out what will be the new beta. It's more a question of practice, and that's why it's amazing. You have so many different practice problems just related to new portfolio betas here. All right. Now we're going to do one on individual betas just to make it, worth it. And we're going to do that. And then we're going to move on to some market efficiency stuff just to be comprehensive on time. Actually, this one you already have the solution, so maybe I won't do it. I'm going to try to find one that's a little bit harder. Let me see what question I would like us to do. Take 2 secs. I guess we'll do a comprehensive question and then we'll move on. Okay, let's do this one. Okay. This one's pretty straightforward, but it does tackle some stuff that we've done in the past. So let's check it out together, and then we're gonna jump into some market efficiency stuff. Okay, so Shy Designs is an amazing architecture firm from New York. Actually, I'm gonna restart, set up our time. All right, so a comprehensive question that may relate on all things CAPM plus different chapters. In this case, equity valuation. So let's look at it. Shy Designs, which is an amazing architecture firm in New York, is not expected to pay a dividend over the next 4 years. So it is not expected to pay a dividend over the next 4 years. That's pretty interesting stuff. Okay. So no dividends for the next 4 years. And then 5 years from now, okay, so 5 years from now, the firm expects to start paying a dividend of $1.28 per share. Okay, $1.28 per share. Then dividends are expected to grow at a constant rate of 2.8% per year in perpetuity. That's hilarious. Note that the risk-free rate of return trends towards 2.8%. Okay, so this should be 8%. Trends at 2.8%. So that's the risk-free rate of return. Okay, so we can highlight that as well. And Shy Designs beta is 0.96. All right, while the market risk premium is 7.5%. What is the current stock price if the required rate of return on the firm stock is expected to remain constant. So we're solving for the current stock price. All right, that's what we're essentially solving for. So you may be like, what the hell am I even supposed to do with this? But once again, I think we could all agree that there seems to be a little bit of equity valuation and a little bit of CAPM in this question. Can you say yes or no in the chat? That we seem to have two chapters here, equity valuation and CAPM. Yes or no? Can we all see this? Like, this should be pretty clear. We can all see that we got a little bit of CAPM, a little bit of equity valuation. So we're kind of flirting with the two, okay? Now, once again, they gave us a few pointers on what we should expect. They talked about this idea of dividends and growing dividends. So, if you're able to kind of just remember the formulas, you would know that if we're dealing with equity valuation and dividends and growth, we're typically looking at a formula like this, right? Or something, although synonymous, something like this. So far, so good. Like, we're able to kind of discover what our formulas should look like, which is cool. K minus G. We also know that if we're dealing with CAPM, right, we could say that it's as easy as this. RF plus beta times ERM minus RF. All right, so we have two formulas that we could play with. And what's awesome is that we could actually find a bunch of stuff that are within these different formulas and try to like solve for them, okay? So we're gonna do that game. We're gonna highlight stuff. We're gonna try to plug them in within our formulas. Remember what I used to say for chapter 5 and what I said earlier. If you're dealing with specific chapters and you're able to pinpoint what topics are being talked about, in this case, it's dividends, growth, therefore, we should be dealing with the constant growth DDM formula. And then they talked about CAPM. They didn't say anything about new portfolio betas, therefore, or alphas. Therefore, we're only dealing with the CAPM formula. Then your goal, your duty, is to find the parameters of these formulas in the question, because they can't ask you to solve for, solve for cancer, to solve for that, right? They're not going to ask you to solve for how to, I don't know, like fly a plane or something. You're looking for a very specific and concise, finite set of things. So it's really, really, really important to just look for those 4, maybe 6 variables in the question. I don't know why I use these random examples, but listen, whatever works. So in this case, they're telling you like, hey, you're going to have a dividend, right? 5 years from now, that's going to be equal to 1.28. Okay, so D5 is 1.28. They're also telling you that that's going to grow at a rate of 2.8% per year. So you know that the G is going to be equal to 2.8%. So already there, we have some sort of like feeling for our G. We know that our D is going to be something around 1.28. Obviously, maybe there's going to be some adjustments with our timeline. We also know that the risk-free rate is 2.8%, right? Right here, we have our risk-free. That's awesome. So we're able to highlight that in our formulas. We also know that beta is equal to 0.96. That's like super cool. And we have our beta right here. And we also know that the market risk premium is 7.5%. Well, that's even easier for us because then there's not a lot of heavy lifting for us to do. Simply market risk premium right here. The underlying concept, 7.5%. So already there, we kind of know that we have everything we need for CAPM, right? If we do a quick little sense check, for CAPM, we have everything we need to solve for something like K. However, if we look at our common stock, or if we look at our, I don't know why I'm having trouble finding the word for this formula, but if we look at our constant growth DDM, we notice that we're missing our K. So we can highlight that in red. However, what's really awesome is that we just realized that our CAPM formula gives us K. So this question becomes super straightforward, like the initial steps. All that you got to do is plug in all of the information you found from the prompt into your CAPM formula. That's going to give you your K. And now you'll have the K that you could plug in within your equity valuation formula. And from there, of course, we're going to have to do a few adjustments to kind of work with our timeline to solve for the current stock price today. Okay, so everybody okay with the first step? solving for K. Do we understand that? Are we okay with this idea? I feel like it should be okay. Perfect. So let's go about doing that. First step, which would be solving for K. So we know that K is equal to RF plus beta times the market risk premium. In this case, it's very straightforward. We know that RF is equal to, thank you. Wow, you're fast. I like it. You're doing very well. What did everybody get for K? I just made the question today, so I could be, slower. That's what you got for K? Interesting. Unless I don't know how to do math. There may be, yeah, MJ, you right, Yuskal, you right. The answer is actually 10% for K. So our K is going to be 10%. Now, obviously, just a quick little distinction. Our market risk premium is 7.5%. This is our risk premium. And don't forget that what this is right here, this is going to be our market risk premium. Yeah. It's fair. It happens when we do it quick. So because we know that this is our market risk premium, we could just substitute all of whatever's in the brackets as being 7.5%. So now we have our K. It's totally fair. I get that. It's very common. And I know you wouldn't make that mistake on the exam. So moving forward, now, step 2 is just getting a sense of what our timeline looks like. Okay, just to make this slightly easier for us. Okay, so we're at t equals 0. We have t equals 1, t equals 2, t equals 3, t equals 4. And I guess we could maybe add a little bit to it. T equals 5, t equals 6. Okay, I think we could all agree that t equals 0 is us today. This is where we're at today. This is the present day. All right. Yeah. Okay, so that's us today. However, our timeline is suggesting that we received a dividend. Well, we're expected to receive a dividend 5 years from now. So there will be no dividends at T1, no dividends at T2, no dividends at T3, and no dividends at T4. However, there will be a dividend of $1.28 at T5. And that's going to grow by G to D6, and so on and so forth forever. Okay, so we know that's going to be the case forever and ever. Okay, all the way to here. Alrighty. So we're going to have our DDM that starts there. Okay. However, we know that we need to kind of plug this in within our formula to find what's going to be our present value. And we could use that formula to our advantage. So by plugging this information in our formula, what's really awesome is that we could actually solve for our present value at period 4. Okay, so we could do that. Maybe I'll make adjustments. Okay, so if we know that D5 is equal to 1.28, and we know that, actually, I'll trick you guys a little bit, just to be funny. Let's plug this in within our formula. So we know that this gives us our present value. So I would like y'all to plug this in as being 1.28 over 10% minus 2.8%. And I want y'all to tell me what will be our present value from that. What would be the present value? Thank you very much. Perfect. So we have that. Amazing. Now I would like y'all to tell me, where do we place this onto our timeline? Is that like our present value today? Is that our present value at T2, at T3? Where is it at on our timeline? Where do we place this onto our timeline? I kind of almost already gave you guys the answer. Where is this present value? Is it at T0, T1, T2, T3, T4, T5, T6? Where is it? Where is the present value? Is this like our final answer? Are we done? Okay. So what's awesome with the formula, and that's something that we covered a lot in chapter 5, in chapter 5 for TVM, is that this is a perpetuity, right? And notice how this is equal to 1 and this is equal to 0. So with a perpetuity, you always go one period backwards. Thank you, Yusha. You always go one period backwards. So in this case, your present value brings you to T4. So we got our present value at period 4. Now, obviously, that's not our present value today because we have to discount this all the way back. And I'm sorry that it looks kind of crowded at this point, but we need to discount it all the way back to T0. Okay, so we have to discount this for 4 periods, such that P0 would be equal to 17.78 over 1 plus K to the power of 4. Somebody tell me what that would give you. There you go. Amazing stuff. All right, so that's how you would solve this question. Now, before we proceed, is this fair? Do we understand what we just did? Are we comfortable? Are we no bueno? Are we bueno? Are we comfortable with the whole timeline stuff? Once again, don't forget, when we're dealing with a perpetuity, you always get your present value one period before, never the same period. There's actually like almost no such thing. So that's why we got our value at P4, and then we had to discount it all the way to P0. So Kennedy and MJ, how do y'all feel? Like, do we understand the mistake? Are we comfortable with the mistake? Where are we at? If you want, I have so much content on chapter 5 too, so it's going to be lit if you want to review that. So like, we're big chilling, we're good. Okay, cool. So we're going to move on now to some market efficiency stuff. Okay, we're going to move on to some market efficiency stuff. Now, before we kind of conclude on CAPM, notice how we only did 3 questions out of quite literally 30 questions or like 32 questions. You have a lot more material to study, okay? And they're all from past exams. Like, they're all from past exams, and then I add my nonsense to it. You know, I make it more complicated, I change the numbers, I add some levels of difficulties. So I really do recommend giving all these questions a shot, because on the midterm, not the midterm, but on the final practice like set, on the mock exams that we're going to do together, I'm going to put them even more on steroids. And because we're going to be doing a lot of questions, sometimes you may feel like you're getting lost in the sauce. But if you do these questions and you take the time and you send the solutions to me, your work, I will be able to tell you, hey, here's a solution, here's what you did wrong, here's some advice. I could literally, like, it's strange because I used to do sports back in the days. I could literally be your personal coach along the way to make this like a really fun process and really help you get there. So please give it a shot. There's a bunch of more questions to do. Now, let's move on to some good old market efficiency stuff. Super easy, honestly. We should have no problems with this. It's very, very straightforward stuff. And once again, what I'd like to say though, is that when we're looking at market efficiency theory, there's about like 2.5 hours, maybe 3 hours worth of content on YouTube. There's a past weekly in which we covered this topic. Then there's also some dedicated YouTube videos on this topic on my channel that discuss market efficiency and that tries to visualize it and break it down into like some bite-sized pieces that are easy to consume. So if you need some extra context, if you want more perspective on the matter, I definitely recommend going there to check it out. Just because now we're going to run through the hardcore theoretical stuff, but we're going to we're going to work through a visualization tool together. And then we're going to do some practice questions together. Yeah, this chapter is literally only theory. There's no mathematics. There's no computational stuff. It's literally, as you can see on the screen, it's qualitative questions, really based on understanding the theory and applying it to something. Now, as you can notice on the screen, there are, types of qualitative questions that you may need to do. And I tried, yeah, so Kennedy, could you please send me a message on Messenger? I will give you access to that Google folder that has all of the prior stuff. And as well, I'll kind of like put you in the right track for the YouTube stuff, like that are the best contents to kind of follow through. And then also if you go in the Messenger chat, like the group chat, if you go into files, you actually have like a, like a recueil, like a paradise worth of documents that you can kind of run through, not including the Google folder. So like you want it, you have it. It's really, really cool stuff. But going a step backwards, for the types of qualitative questions you may expect on your exam, I tried to break them down as much as I possibly could. Because when you're dealing with qualitative questions, it is slightly more difficult to funnel them into some easy categories, but we're going to try to do so still. So here are 3 types of qualitative questions. The first one will be event-based market efficiency theory questions. The second one will be matching type of qualitative questions for market efficiency. Then the third one will be which of the following is type of market efficiency questions, okay? That's like the best we could really do to segment them into pieces. But if we work through the first segment, which is going to be event-based qualitative questions for market efficiency, we're typically going to ask you one of 2 things. One, is this a violation of a specific type of market efficiency? And then 2, is this consistent with a specific type of market efficiency? This is really what you should expect within the event bucket, whereby we're going to give you an event, something, a context, a scenario, a situation, and you will have to assess whether this violates market efficiency theory A, B, C, or whether this is consistent with a specific type of market efficiency. If we move on to the second type of qualitative questions under the chapter of market efficiency, there is the matching one. And there's 2 subsegments here, which is matching a topic to a form of market efficiency or matching a form of market efficiency to a topic. It really boils down to the same thing. And to make it a little bit more clear for you, what does this mean? This means that they may say, well, hey, the random walk is essentially saying that the price of a stock yesterday will not affect the price of a stock today. Well, which form of market efficiency does this match with? And then you would say, well, hey, that's the weak form of market efficiency. That's what a matching type of question is all about. They may say insider trading is usually used and talked about within which form of market efficiency? You would say that this has been discussed within strong form market efficiency because it is impossible to use insider trading there. So here's an example of matching a topic to a form and matching a form to a topic. Will you see a lot of questions like this on the exam? I don't think so, but there's still a type of segment that I would want to kind of qualify for y'all. Now, the third category of qualitative questions for market efficiency will be which of the following is either 1, most correct, or 2, not correct. It's quite literally a simple multiple choice question, which you're going to try to figure out, well, which of the following statements really matches with market efficiency theory of one sort, or really does not match with market efficiency of one sort. And we're going to try to give you the tools today to really work through this chapter. Once again, market efficiency isn't a difficult chapter, and I'm going to try to boil it down for you. And also, once again, you have so much resources available to you. I feel, however, that market efficiency theory, that chapter, really relies on visualizing what it means. And we're going to try to run through this visualization process in 2 different methods. All right, that's what we're going to try to do today. So the first method will be on the next slide here. And that's kind of giving you a general overview of what market efficiency theory is. If you're really a study the words type of person, like you like reading something, making sense of it, and then highlighting it, this will be a really, really strong way to make sense of what market efficiency theory is all about. Because as you can see within the summary, what market efficiency theory really tries to display is trying to display to what extent are market prices, in other words, stock prices, reflecting available and relevant information out there, okay? Ideally, a market price, a stock price, would reflect all the information available on Earth such that nobody could gain some abnormal returns. In other words, nobody could beat the market. In other words, the market would be fair for everybody. Let me give you an example, okay? Let's try to consider what the heck does it mean to have information, okay? Let's say that you are best friends with Elon Musk. He goes out with you, you go out with him, you drive the Teslas, you're really having a good time, okay? Even on the yachts. And he tells you everything about the company before it becomes public, okay? If you would have such information, if you would have such discrete, private, insider information, would it make sense that you would be able to make some really good returns on the market? Because you would know when to invest and when to divest your position into Tesla. Would that be fair? Is that something that would make sense to everybody here in the chat? Yes or no? Because you would have, literally the CEO telling you everything. So you would know when to invest, when to divest, when to, do stuff related to the stock. Yeah, that makes sense, okay? Now, let me ask you this. Is that unfair? If you're the only person on Earth able to make millions of dollars on Tesla stock, while everybody else is trying to figure out stuff, like a normal person, is that unfair? Yeah, 100%. That would be totally unfair, that only one person or a group of peoples are able to game the market, okay? So market efficiency is quite literally stating that ideally a market would be efficient, in which all of the information, either public, private, or historical, would be represented in the stock's price, such that nobody would have an unfair advantage, or nobody would be able to earn abnormal returns on a consistent and systematic basis. Okay, that's what we're talking about here. Now, let me ask you all another question. Let's say that you had a whole summer to yourself and you wanted to look at historical prices to beat the market. In other words, let's say, and let's stick with Tesla's example, let's say that you studied all of Tesla's prices over the last, 20 years or so, all right? In the hopes of earning abnormal returns, in the hopes of beating the market, in the hopes of making millions of dollars because you're a genie, all right? But you're the only one who knows this. Would this be a sign of an efficient market that's fair for everybody? Yes or no? Would this be a sign of a market that's efficient and fair for everybody? Yes or no? If you're able to study past prices of Tesla and find this magic trick that allows you to make millions of dollars, would that be a fair market? Would that be an efficient market where people would be confident in putting their money in that market? Yes or no? Put it in the chat. Yes or no? All right. If you were looking at Tesla's stock prices, if you don't know what that would look like, no, but only you, MJ, only you. You're the only genius that knows this. You found the magic trick. You're literally Einstein, okay? It wouldn't be fair, right? You looked at the prices and you saw, oh my God, okay, I could do this, I could do that. That wouldn't be fair, right? And obviously, the reason why I mean this wouldn't be fair is because what if I just don't have a finance background? Or this is not public information that Tesla would want out there. Let's say I'm an immigrant mother that came to Montreal, worried sick with her kids that can't really figure out everything about the stock market. It wouldn't be fair. And that wouldn't make it a very safe place for people to invest their money in, because there would be outlier scenarios that are not good, okay? So this is just a small introduction to what I mean about this idea of market efficiency. But let's go past that. Let's try to kind of delegate market efficiency into 3 different segments, okay? The first segment will be a weak form of market efficiency. The second segment will be a semi-strong form of market efficiency. And then the third segment will be a strong form of market efficiency. I think it goes without saying that obviously if you're weak, you're probably the worst type of market efficiency. And if you're strong, you're probably the strongest and the best form of market efficiency, okay? If we double down within the first segment, the weak form market efficiency, what I highlighted here are really two types of notions that you should probably remember when talking about weak form efficiency that you should probably relate to weak form market efficiency. And that is technical analysis, as well as the random walk. Now, the first subsegment, which is technical analysis, is quite literally the study of past stock prices. In other words, studying the past in order to be able to dictate the future. So in other words, studying Tesla's prices maybe 10 years ago to figure out what will be its price tomorrow. That's an underlying, very simple way to understand what technical analysis is within 20 seconds. The second subsegment within the weak form market efficiency that I would probably recommend you remember is this notion of the random walk. The random walk is simply stating that a price of a stock, right, will not, I guess the price of a stock today will not dictate the price of a stock tomorrow, okay? That's the best way to describe the random walk, such that studying past prices will not be able to dictate the price of a stock tomorrow because it follows a completely random, arbitrary, out of nowhere, unsystematic pattern that nobody could try to figure out, okay? So that's really important. Now to kind of tie a bow on this idea of the weak form market efficiency, what you want to remember is that if a market is weak form market efficient, so if a market is weak form, I guess, weak form efficient, what you want to remember is that the market, all right, the overall market, the overall stock market is going to reflect all past prices. In other words, it's going to reflect all historical information. And what is the key takeaway here? What is the so what for you? Well, you want to understand that if the market reflects all past prices, in other words, all the historical information, investors, okay, cannot make abnormal returns. They cannot beat the market by studying these past prices. However, they may have an opportunity to beat the market by studying other types of information, okay? So I'm going to move on to the second segment, the second type of market efficiency, and then the third one. And once I'm done with that, I'll give us the opportunity to talk a little bit about these implications and really make sure that everything's okay there. Okay, so let's move on to the second type of market efficiency. Actually, am I talking too fast? Or is this okay? Is this helping to give you some sort of context? Or do you guys want to go through this? Just to be sure. Is this good? Yeah, okay. If there's nothing being said, I'm going to assume it's okay. So second type of market efficiency form. The second type will be the semi-strong form of market efficiency. And within the semi-strong form of market efficiency, there's really only one topic that you would want to remember. The subsegment being public available information. Okay, what is public available information? Well, public information can be defined as being press releases, financial statements, quarterly releases, anything available outside in the public eye. And why does that matter? Well, because under a semi-strong form of market efficiency, it is stated that public information could not help investors earn abnormal returns on the stock market. In other words, if somebody was to study a financial statement or a press release from Elon Musk or anything that's available publicly or a newsletter, they would not be able to use that to earn better returns than what is expected on the market. Okay, that's really, really important because now we're saying that the market is so efficient that all public information is already being priced in the market. Everybody knows this stuff. So you can't beat other people in this game because everybody already knows this information. Now, let me give you more context on this. All right. In this world of investing, in this real world that we live in, okay, there are large banks, there are large investors, there are really smart people with very big computers and very smart PhDs, MBAs, blah, blah, who are looking at the stock market every day. So of course, public information will be studied by them like that in a second. I mean, I spoke with some not some insider, with some what's it called, sales floor trading type of people at a big bank in Canada, and the first thing they do in the morning is read the news, is read financial statements. That's the first thing that they do to really understand what's going on in the market, and that's one person. Imagine a large bank filled with thousands of people like that. Imagine a large bank filled with thousands of people like that who are focused on one type of industry in the world. Of course, they'll be able to go through all of the public information and use it to their advantage. But not only that, there are several banks like that. There are several people like that across the world. So everybody has this information. So it would not help anybody to use it because everything's already being priced in. Everybody already knows this when they're making their investing decisions. Hopefully that gave you a little bit of context. Maybe review the video afterwards and kind of like try to run a little example on a piece of paper. So to tie a bow on a semi-strong form of market efficiency, what you want to remember is that all public information is reflected in the market prices. In other words, all public information is reflected in the stock price, okay? But one little caveat for you. When we're saying that a market is semi-strong form, we're also saying that everything, okay, everything that was said about the previous form, so the weak form, also holds. So what am I saying here? I'm saying that if you're semi-strong form, if you have a semi-strong form market efficiency theory here, you would say that all public information is priced in, but also all past prices are priced in. In other words, if you're a semi-strong form, you're also weak form, okay? So if you're a semi-strong form, you also know that past prices and public information are priced in, all right? So let's move on to the third segment, right? And that's a strong form of market efficiency. A strong form of market efficiency only relies on one subcategory to really remember and get a sense of. That's the idea of insider information. And we spoke about that just a little bit prior to getting to this segment. And insider information is very simple. It's somebody that has private inside information that nobody else has access to, either through illegal means or through, some sort of speakeasy vibes, but they got the information and that's illegal. But what's awesome with the strong form market efficiency is that it states that people could actually not make abnormal returns or yield some better returns on the market by using insider information because the market is so efficient. The market is so efficient that it would have priced in all potential private information out there, that it would not affect the prices at all. Now that's a very strong basis to have. Whether it's true or not, it's a whole different topic. But within a strong form of market efficiency, we would say that insider information would not benefit investors. It would not benefit investors in earning abnormal returns, which is pretty awesome. And what's really cool here, and I guess I'll tell that in just a second once I'm done tying a bow on the strong form, but there are some really good takeaways from this in terms of just yourself in the future when you're going to want to invest. But let's kind of finish off the strong form market efficiency theory here. If you have a strong form of market efficiency, this means that stock prices reflect not only all historical information, but it also reflects all available public information. And then it also reflects all available private information. So nothing could help investors beat the market, okay? But what I want you to notice though, still, if you're strong form market efficient, you're also weak form and you're also semi-strong form, okay? The rules that apply to a weak form market and the rules that apply to a semi-strong form market also apply to a strong form, okay? That's really important to understand. Now, before I kind of ask if there are any questions or whatever, I would like to say one thing. The reason why market efficiency theory is really important and the reason why there are laws, regulations, governing bodies that are tracking markets is because as an investor, if you do not feel safe investing in a market, right, you will not invest in a market. And that would reduce the amount of funds, the amount of capital available out there in the world. And that's actually pretty bad for an economy. Now, what's awesome is that if the market is efficient, this would mean that all individuals would be pretty okay, they would feel safe placing their money into the stock market because they understand that others cannot, benefit at their expense, that others cannot earn absolutely crazy returns. Okay. Now, my last little note here would be that if somebody wins in the market, that means that somebody lost on the market. Okay. Right? It's still supply and demand. Somebody has to buy your stock and somebody has to sell their stock. So that's why it's really important to have an efficient market. I'm kind of going into the ethics of finance, but that doesn't matter. I mean, that does matter, but it's not within the scope of what we're talking about now. So that said, do we have any questions? Anything that wasn't clear? Anything that you would like maybe a different view on? Are we okay with this slide? I know I spent like 8 minutes on it. So how are you feeling? You good? Bad? Decent? Awesome. Well, I'm going to test y'all and see if y'all are really doing good with it, because we're going to have some exam questions on this in just a second. So what I did here, by the way, so this is a different view that you could take on market efficiency. So this is a different way to look at what's priced in and what's not priced in. What I did, as you can notice on this chart, is you have types of market efficiency. You have the weak form, semi-strong form, and none of the above. And what I did is I categorized this into 2 segments, okay? Like personal knowledge you can, but like private information, public information, or past prices, no. But if you just happen to be a genius for whatever reason, and you see numbers in a different way, then yeah, you could. But obviously, Kennedy, that's mad, like super unlikely. There are some funds that have some crazy IP that are able to do it, like Bridgewater Associates, like the Medallion Fund, but those are uncommon within uncommon people, But that said, what you see here is a different way to kind of maybe want to work through these questions for market efficiency. So we have the 4 different types of forms, well, the 3 different types of forms, and then 1 not being any. And then you would see, well, what's the priced in information for that form and what's the information that's not priced in? So just to quickly run through it, if you have a weak form market efficiency, this means that historical prices is priced in, but this also means that public information and private information is not priced in. What the heck does not priced in really means? Okay, something not being priced in means that investors can use this information to yield abnormal returns. Let's take a step back. If we're under a weak form market efficiency, all right, this means that historical information is priced in. Therefore, investors could not yield abnormal returns by studying historical prices. However, they can earn abnormal returns by studying public and private information. Why is that? Because that information under a weak form market efficiency will not be priced in. Okay, let me give you another example. This is just another tool, another thing that I would recommend you putting on your cheat sheet, because it's going to help you kind of solve these questions. Now, let's say that we have a market efficiency that is considered to be none of the above. In other words, it's considered to be inefficient. Okay, it's not weak, it's not semi-strong, and it's not strong. All right, so this means that no information is being priced in, none at all. Historical information, public information, and private information is not priced in the stock market. So what does this mean? This means that investors could benefit, right? They could yield some abnormal returns by using historical prices, public prices, and private information to their advantage. So you could use this little table to your advantage in order to figure out, well, when I have a question, what should I say in terms of whether it violates something or whether it's consistent with a form. So just another tool that you could use to your advantage. It's a really good way to kind of have that on your side as you're doing some market efficiency exam-like questions. Now, the final thing I'd like to cover is really like an example. I don't know, I just want to give you guys another way to look at it. And it's really this idea of when you build a home, you need a foundation. Once you have the foundation, you can start building the home. And then once you have the home, you can start designing the home, right? These things work in tandem. You cannot have a home without a foundation, okay? The same thing with a pyramid. You cannot have a pyramid without its base, right? And you cannot have the peak of the pyramid without its base plus the supporting piece in the middle, okay? So the same idea is I'm trying to apply it to market efficiency. So what does this mean? What I'm trying to say is that this right here, this little piece of our pyramid, okay, is what we're going to coin as being stuff, whatever. I can't draw into the lines. 22 years old and I still can't do it. It's rough. But all jokes aside, this is the peak of our pyramid, okay? So what am I trying to say? Is that this represents a strong form of market efficiency, okay? The peak of the pyramid would be a strong form of market efficiency. That's what I'm trying to represent. But obviously, could we have the peak of a pyramid without its base and the supporting piece in the middle? Yes or no? Could we have the peak of a pyramid without this and without this? Somebody tell me in the chat, yes or no? Can you have that without the foundation? No, you can't. All right. So what I'm trying to display here, maybe in a bad way, is that you need to have your foundation. And the foundation would be the weak form of market efficiency, right? That's what the foundation would be. It'd be the weak form of market efficiency. All right. So you would have that. This would be the weak form. All right. Then in the middle, we could have, for example, what's highlighted here in blue. It's sad that I'm trying so hard to be able to draw between lines because I low-key don't think I can. We would have a semi-strong form. So why did I take the time to do this kindergarten like little drill? The reason why is because what's really awesome is that you get to notice that you could have a weak form market efficiency. So your market could be weak form market like efficient, right? Without being strong form and without being semi-strong form. Okay. However, you cannot have a semi-strong form market efficiency without it also being weak form market efficiency. So what does this mean? This means that the rules that apply to the weak form also apply to the semi-strong form, okay? And now what I'm also going to say is that if you have a strong form of market efficiency, this means that the rules of the weak form and the rules of the semi-strong form also apply to the strong form market efficiency. So it's really this idea of like your base foundation to getting to the peak of what we're building. So that's why this is awesome, because you know that here, past prices, here we have public, and here we have private. Okay, so if you're in a strong form market efficiency, this means that the rules towards past information apply. This means that the rules towards public information apply. And this obviously means that the rules towards private information apply. All right. However, if you're semi-strong form efficient, this means that the rules for past prices apply and the rule for public prices apply. However, the rules for private prices do not apply. I feel like we get what I'm trying to, state here, is that you cannot have one without the other. Okay. Hopefully this gave you a little bit of context on what to expect and how to visualize this idea of market efficiency. I recommend while you are practicing this document, while you're going to be practicing on your own time, and while you're going to be doing the mock exams with me, have a cheat sheet for every single chapter. It does not have to be the cheat sheet that you're going to be using on your final exam on August 9th or 14th. Just have something that you could refer to quickly while you're studying these types of questions. And for market efficiency, I would recommend having these 3 slides to your disposal because they should really, really work depending on what type of student you are, either more visual or more, written, blah, blah, blah. They should really, really work for you. So I hope that helps. And with that, we could jump into some classic market efficiency gigs or stuff. I can't even speak English. Okay. And then we're gonna do this for like 10 minutes, then we're gonna jump into some options. Options are one heck of a ride. So we're going to run through these and hopefully you guys have questions and we can go through it. So this is a violation type of, like this is an event type of question, and we're going to look for a violation, okay? Kind of a strange sentence out of context. But anyway, Sarah discovered that she can make abnormal returns when she buys stocks of companies that have reported growth in their operating margins, okay? Which of the following best describes this event? Is this a violation of all forms of market efficiency? Is this a violation of a semi-strong form of market efficiency? Is this a violation of a weak form? Or this would not be a violation? Like where are we looking at? Is it A, B, C, D, or E? Abnormal returns. That's pretty interesting. When she buys stocks of companies that have reported growth in their operating margins. They have reported growth. I wonder how people report stuff. I'm gonna let everybody give it a shot. Okay. Let everybody have a shot. Yusra, what you got? Okay, so the answer here is actually D, 100%. Okay, and we're going to go through them one by one. Okay, so this would be a violation of all forms of market efficiency. So this means that this would be a violation of the weak form, the semi-strong form, and the strong form. Now let's see if that's the case. If you're a weak form, right, you could only not use past prices to beat the market. However, in this case, Sarah decided to use public information, right? Because it was reported, right? Reported in a release, in a statement, and whatever. This is public information, okay? So technically, if Sarah was under a weak form of market efficiency, this would be okay. She would be able to make these abnormal returns. Is that fair for everybody? Quick yes in the chat. Quick like why, if that's fair. That if we were in a weak form market efficiency, she would be able to do this, because in a weak form market efficiency, you simply, if we go back on our little thingy, in a weak form, you could simply not use historical prices. In this case, she used public prices. So she's living by the law. All right. So in this case, this would be false, because this would not be a violation of a weak form market efficiency. However, under a semi-strong form of market efficiency, if we go back to our model, it says that you could not use public information because it's priced in, okay? You could not do that. And for that reason, this would be a violation of the semi-strong form. And if you guys remember what I mentioned right here, if you are strong form market efficient, you are also semi-strong form and weak form, okay? So of course, if you're not semi-strong form, then you cannot be strong form, okay? And for that reason, it is also a violation of the strong form market efficiency. So A is wrong, okay? Now saying that this would not be a violation of a semi-strong form market efficiency is also wrong, because we said it, we saw it on our little graph there. If you are in a semi-strong form of market efficiency, you are not allowed to use public information to yield abnormal returns. And in this case, she did. So it's impossible that this is not a violation of the semi-strong form. Now, if we look at C, okay, this would be a violation of the weak form market efficiency. But we said that that's not true. We said that under a weak form market efficiency, you are allowed to use public information and private information to yield abnormal returns. And for that reason, C is no bueno. Now, what about D? D says that this would be a violation of semi-strong form market efficiency. Well, of course it is, because once again, and I hope this really helps y'all, okay? And I'm gonna kind of like erase stuff. As you can see on this little graph here, is that whatever, okay, Whatever is under, whoops, sorry about that. Whatever is under the semi-strong form here, you can notice that if it's priced in, right? This means that historical and public information is priced in, okay? This means that investors cannot use this information to beat the market because the market has already understood, they already priced in this information, okay? Such that, of course, this would be a violation because here, we're telling you, hey man, she did that. And we can't do that under a semi-strong form, okay? So C is correct, D is correct. Now let's look at E, just for fun. This would be a violation of weak form market efficiency. Already here, it's no good. You don't even need to continue. So yes, the answer here is D. Overall, do we have any questions related to this one? How do we feel? Is this clear? Do we understand why my graphs now are maybe kind of useful? Because they really tell you what to do. Okay? Amazing stuff. So we're going to go with another one. Whoops, I guess not this one. Yeah, 100%. It's so easy to get confused. Like, that's why I recommend always kind of doing a quick test when you do these questions. Always do a quick little test in which you're going to try to figure out already from the very beginning whether this respects all three forms. That's the first thing you want to do. You want to do like a sense check when you start these questions, okay? So you like build like a little structure. You do this, you do this, you do this. So you see if it passes weak, then you see if it passes, semi, and you see if it passes strong. That's what you want to do before every single question, all right? That's like really the best practice to have here. Okay, so this one's interesting. It's a long question, pardon my French. But Sukena reads the Japanese Financial Times every Monday. And this week, all right, she reads that Tamago Inc., all right, Tamago Inc. reported higher, all right, keyword here, reported higher yearly earnings alongside companies like Nissan, Volvo, and others because of better advertising practices. Therefore, their common stocks expected to grow by 2.8%. Moreover, Sukena reads Tamago Inc.'s end-of-year press release, and she believes now that it is evident that their stock should increase even more in the coming weeks. So she read their press release. Interesting. All right. And she believes it is evident that their stock should increase. Now on Monday evening, so that same evening, Sukena bought Tamago's stock, hoping to make absolutely sick returns. Sick returns that have to be posted on Wall Street Bets after. However, nothing happened. Literally nothing happened. She did not make any sick returns at all. And the stock's price actually remained unchanged. Okay? So which form of market efficiency is this consistent with? Okay? Which form of market efficiency is this consistent with? This is some strange stuff. There's a lot of text. But we're going to do our sense check. We're going to run through the weak form, run through the semi-strong form. We're going to run through the strong form. Okay? So if the market was weak, investors would be able to read public information just like Sukena did, right? Notice how reports is really us talking about public. This is public information right here as well. So like, obviously she's studying public information. But if we were in a weak form market efficiency, Sukena would have been able to make some sick returns. However, in this case, she wasn't able to. So for sure, this market is definitely not weak, okay? However, is this market semi-strong form? Well, under a semi-strong form market efficiency, investors are actually not able to use public information like she did to beat the market. So it's definitely semi-strong form. And if a market is semi-strong form, if we go all the way back, it's for sure, right? In this case, going to be strong form because there's no private information being discussed. But anyways, so that's something that we understand. So we're assuming it's semi-strong form, and if it's semi-strong form, in this case, and there's no private information, we're also going to say that it's strong form. Okay, so we have that. So we know for sure that B should be correct. We know in this context that A should be correct too. We know that C is not correct, and we know that D is not correct. It seems like A and B is probably good. And it seems that B and C, of course, would be false. And all of the above would be false, and none of the above would be false. So in this case, what seems to be the answer? Is it A, B, or is it E? What is the answer? What do y'all think? Kennedy says E. Yeah, it's obviously E. I mean, now in the solutions, for whatever reason, I put A. I guess I was like sleeping on the wheel, but it's not A. It's definitely E because it abides by the rules of a semi-strong form market efficiency. Now, honestly, on an exam, this could be a caveat. And because you guys are in person, I would definitely ask just for fun, is like, they didn't mention anything about private information, but by definition, if there's nothing mentioned about private information, like for sure this is consistent with semi-strong form. They didn't mention private information, so they could say, well, you know what, it's only B. But if I were the teacher, I would say that you're okay with saying that it's A and B. That's my position. I wouldn't mind on an exam, like kind of like saying like, yo, hey, you didn't say anything about private information. But because by definition, yeah, you could go for B or E. I'm gonna go with E. That's gonna be my guess, not my guess, but my position. Just because I'm gonna assume that there was no private information that could have been used. But B is also a correct answer. Like this is one of like those ambiguous ones, like where they look at how many students actually got it right or how many students got it wrong out of the total set. But for me, I would go in between B and E. They're really like both pretty decent. Like they're both, I would be okay with both. Okay, so now we'll do another one, super quicks. So technical analysis can be defined as a study of previous prices and historical trends. For example, one could study the previous prices of the market index. Which form of market efficiency is this practice based on? What is the answer? You guys remember what I said at the beginning of our market efficiency section? You would know where this should go. Exactly. Pretty straightforward stuff. Exactly. So A, I mean, very easy. That's like one of our matching questions. And then I'm gonna go with this one. Okay, we're gonna do one more, and we're gonna move on to options. So let's go to it. So which of the following is most correct? Let's check that out. If capital markets are semi-strong form efficient, okay, so they're semi-strong form efficient, then stock prices will reflect all available public information, but it won't reflect historical prices. Is that true or false? Is that correct? What do y'all think? If capital markets are semi-strong efficient, exactly. So this is no bueno. All right. Already here, if you're on an exam, you know that this one is wrong and you know that this one is wrong. They could give you like six options like they did here, but just by figuring out A is wrong, you know that E and G is wrong as well. Okay, you know, oh my bad. You also know that F is wrong because it has A as well. All right. So if capital markets, that's for B, if capital markets are considered to be inefficient, okay, then investors should yield abnormal returns by conducting technical analysis. It's pretty interesting. If capital markets are considered to be inefficient, investors should yield abnormal returns by conducting technical analysis. Is that true or false? They're inefficient markets. Is this true or false? They're inefficient, so people could yield abnormal returns by conducting technical analysis. I got one true. Need one more answer, maybe? That it's true. This one is for sure true because if a market's inefficient, right, it's not weak form, it's not semi-strong form, it's not strong form, and by definition, investors can have a party, right? They can make money easy, and they could definitely make money using technical analysis. Now let's look at B. So insider trading will yield abnormal returns under an inefficient market. Is that true or false? True or false? Under an efficient market. Sorry. That's definitely false. All right. Now let's look at D. So if capital markets are weak form market efficient, so weak form, then stock prices will reflect all public information. All right. So if they're weak form, they're going to reflect all public information. Is this true or false? Exactly, false. So this has to be false. So the answer here is definitely going to be B. Now, I don't know what I was doing that night when I was making this stuff up, but I gave you all wrong answers at the bottom. But here it's B. The answer here is B. I guess I was trying to put you off if you guys wanted to cheat. I was thinking ahead of the game. So that's it for market efficiency. Okay. I'm gonna probably do like a 10-hour video, like low-key this week, just for fun, which I'm gonna cover all the questions covered in this chapter, in this PowerPoint, or I guess in this slide deck, just because I want to help out. Why not? But what we're gonna do is we're gonna take 2 minutes. We're gonna get back here at 6:15, just because I need to drink some water and get back into it. Then we're gonna do some options together. Okay, we're gonna do a lot of exam questions for options, and I'm gonna give you the methodology that I believe makes an amazing answer, an amazing student. Okay, so we're gonna take 2 minutes. We'll be right back in 2 minutes. Alrighty, so 2 minutes, and we'll be right back. Just because we need to breathe a little bit. Y'all have been doing really well tonight, though, so I'm really happy about that. So 2 minutes. Okay, let's get it. We got another 45 minutes to go. I'm gonna run through the idea or the ideas related to what's an option. I feel like my other video does a pretty good job, and it may not be as useful as it may need to be on your final exam when it comes to like solving some exam like questions on some surgical levels. So what I'd like to do real quick is just tell you that for options, it's kind of strange, right? There are really only two types of quantitative questions. I don't know why it's written qualitative. So quant questions, there are only really two types. And it's going to be solving for the payoff of a portfolio or the profit of a portfolio. What's really awesome is that solving for profits really piggybacks on the idea of solving for the payoff. So they really go hand in hand, but I tried to be like comprehensively exhaustive, like type of thing. Like I really wanted you to get a good view there. But don't you worry. Listen, the questions all look the same. They're the same thing. You always have to do the same damn thing. So you're gonna find it super cool and super straightforward. The only thing I'd like to kind of share before we jump into some questions is one, just giving you a definition on what is an option. And two, I did this for two, but two, understanding how to visualize an option and really what's the general practice being done here. So as you can see on the screen, an option is the right to buy or sell at a fixed price an asset for a specific amount of time. All right. So what do you want to understand is that there are two types of options, right? One will be a call option, which is the right to buy an asset at a fixed price for a specific amount of time. And then there is the put option, which is literally just the right to sell an asset at a fixed price for a specific amount of time or a specified amount of time. This might seem like kind of strange at first, but what's awesome is that with a simple visualization technique, this could make a little bit more sense. And it's going to give you a little bit more intuition when actually solving for your payoff, profit, and building your payoff diagram. Okay. So here's an attempt to visualize options. All right. So a few things that I'd like to mention, I know it's a lot on the screen, a few things that I'd like to mention is that here we're going to have a stock price. Okay. So on the horizontal axis, you're going to have the stock price. And right here, you're going to have the payoff. Okay. Payoff is very bueno. Payoff you like. Payoff is money in your pockets. Okay. So we're going to begin with the call payoff, in which the call payoff like table, in which we have an example right underneath it. Okay. We're going to have a small little example. This example is actually portrayed throughout our graph. Now, once again, our graph displays a call payoff in which on the horizontal axis, you have the different stock prices. And on your vertical axis, you're going to have your payoff. In other words, the total money you're making on this project. Okay. So let's check it out. Let's assume that we're dealing with a call option. Could somebody tell me in the chat, what is a call option again? Does that give us the right to buy or to sell? Somebody tell me in the chat. The right to buy or to sell it. What is a call again? I forgot. Oh man, I don't know what to do. Exactly, it's to buy. So a call option gives you the opportunity to buy something at a specific price. Okay. In other words, right now it's the option to buy an option on an underlying stock. Okay. And that option has an exercise price of $30. What is an exercise price? An exercise price is literally the price at which you're going to be able to purchase the stock. So let's say Tesla is what you're interested in, and you got a call option at an exercise price of $30. This means that you would be able to buy Tesla at $30 for a specific amount of time, no matter what the price of Tesla, which is an awesome deal sometimes. Okay. So what's really interesting here is that let's play the Tesla game. Let's say that Tesla right now, it's trading at $60. Okay. So the stock price of Tesla is trading at $60. However, you have the right to buy it at $30. Let me ask you all a question. Will you buy Tesla for $60 like a fool, or will you buy Tesla with your option at $30? Tell me what choice you will take. I need at least another answer. Just one more. What will you do? Yeah, for sure you're gonna buy it. You're gonna buy it at $30. It doesn't make no sense to buy it at $60 like a fool. You got an option. So what's awesome is that you're actually gonna be making this much money. That's a lot of money to make. Okay, you're gonna be making $30 in savings. All right, you're gonna be making $30 in savings, which is awesome. Okay, so $30 in savings, which is really cool. So this is how much you're saving. Okay, this is your payoff. This right here, this $30 that you made, okay, it's gonna be your saving. In other words, your payoff. That's how I like to visualize it, just for you to really see what are the dynamics at play when making these decisions. Okay, so that's awesome. We know that if we have an option on Tesla for $30 and it's selling for $60 on the market, we're going to use our option. Okay, now let me ask y'all a different question. We're going to use a different scenario. Let's say that Tesla is trading at $10 per share, but you have an option to buy it at $30. Let me tell you, what are you going to do? Are you going to buy it at $10 or are you going to buy it at $30? What's your option? What are you going to do? What will you do? You have the right to buy it at $30 or you have the right to buy it at $10. Where will you buy? What will you buy? Will you buy? Yeah, you're gonna buy it at $10. You're gonna bite the bullet and you're gonna buy the Tesla stock on the stock market. You're not gonna use your option. In other words, you're not gonna exercise your option. Okay? And because you're not a fool, obviously, if you don't exercise it and you buy it at $10, well, then your payoff is null. You made no money, right? That's the idea here. The idea here is that if Tesla stock is smaller than your exercise price, you would never exercise your option, such that your payoff would always be equal to zero below $30. Okay? Because it wouldn't make sense for a human that actually went to school and that lives in society to decide to pay more on their option than pay what's on the stock market. Your option would only be valuable to you at the very cent above $30. Okay? Is that fair for everybody so far? Do we understand what the heck a call is now? Are we good? Yes or no? I need to see a yes, because I feel like that was not a bad explanation. I was kind of sick with it. But anywho, all jokes aside, we can now move on to the put option. Okay, now the put option, we're going to look at it once again from a very similar lens, in which we have a put option, okay, on Tesla stock, all right, on Tesla, and it has an exercise price of $30. Could somebody tell me, is a put option the right to sell, to buy, to negotiate? What is a put option again? I forget. Ah, damn, exactly, it's to sell. So you have the right to sell. Now, what's awesome here is that let's assume, okay, that let me go with a random example. Let's assume that right now, okay, Tesla stock is trading. $0 is kind of aggressive. I'm not gonna lie. Let's go with $10. Let's say a Tesla stock is trading right now for $10. Okay, and people are buying it for $10 on the stock market. But you have a really awesome put option. You have a put option that allows you to sell it for $30 to anybody. Now, will you rather sell it at $30 or would you rather sell it at $10? Somebody tell me. Would you rather sell it at $30 or would you rather sell it at $10? You're going to rather sell it at $30 because you will make a really cool payoff. You're going to make an amazing payoff. You're going to make some pretty solid payoff. Right? You're going to make a payoff of $20. Now, a few things to note really quickly. What's awesome here is that you get to see the difference between a call option and a put option. Notice how if Tesla stock is trading at $10 under a put option, you will be able to make 20 bucks. That will be your payoff. However, if you're dealing with a call option, your payoff is equal to $0. That's the nuance between a call and a put. And that's where it gets interesting when you build a payoff diagram and with multiple options, right? So really, really cool. That said, I would like to ask you the last question before we start, jumping into some cool stuff. Let's say Tesla stock is trading for 50 bucks. Okay, so it's trading for $50, but you have the right to sell it for 50 bucks. I mean, for 30 bucks. Are you going to sell it for 30 bucks? Or are you going to sell it for 50 bucks? What are you going to do? You're selling for 50. You're not even going to do anything. You're like, my option, it's not even worth it. Golly, not even worth it. So, of course, you're not making any money on selling your option at any point beyond $30, because then it just wouldn't make sense. It wouldn't provide any benefit to you. So that's how you quickly run through the notions applied to just anything related to visualizing options. It's really, really as easy as that. And we're going to use the same frameworks when we're building our payoff diagrams for large, complex portfolios, apparently. Okay. This is something that I'm not going to spend a lot of time on. The factors affecting option prices. Like, what I would recommend you to do is to just add this little table onto your formula sheet in the event that you get that one, or maybe literally that one individual multiple choice question that will be on your exam, because this would guarantee you some points, because you literally just have to figure out, not even figure out anything. You just look at this table and you look at the multiple choice and you just say, oh yeah, it's true. Volatility would increase a call options price. That's it. So I won't spend too much time on that. Maybe we'll add one into our final mock exam, but this is just something that I would say add to your cheat sheet, okay? Literally, just put it to your cheat sheet. You're allowed to have one. It's 2 pages. Like, just use this. Useful stuff. What we're going to do now is we're going to select some pretty awesome questions, and we're going to do them together. We're going to do them for the next 30 minutes. And we're going to try to run through 2 at least. That's my goal for today. Now, I don't know why I'm here, not there. So let me just grab a solid question from question bank, and we'll get to it. One with profits. So, not necessarily. I wouldn't think so, realistically, Kennedy, but I would definitely recommend kind of like building the skill though. But what I'm going to do though, by the way, is I'm going to help you guys build a payoff table, because that's something you will need for your exam, just to be able to do this in a clean and systematic way. The payoff diagram, not necessarily, but I'm still going to teach it to you just because it's a good tool to kind of sense check what you're doing. But the payoff table is more than enough, realistically, Kennedy. Okay. So we're going to start with this one. Okay. So we're going to do this question. All right. So suppose that Jake and Sarah are interested in speculating on Apple's stock, all right, which is currently trading at $28 per share. The couple's considering to build a portfolio with the following positions. Okay. Following positions. And the first one being, we're going to buy a put option. All right. A put option with a strike price of $38. However, it also has a premium. So buying this put option is going to cost us money. Then we're also going to sell 2 put options with a strike price of $22. And they have a $1 premium each. Okay, so they have a strike price of 22 bucks each and a $1 premium each. Okay, so far so good. Now, what's awesome with this is I'm going to literally make this easy for you. Okay, there's just one trick to use. The simple trick. It's easy. You're going to build a payoff table. Okay, and that payoff table is going to look a little bit like this. And you could use this trick at all times forever. It'll never fail. It's like one of those things that you just, it works for whatever reason. Okay, so the first thing that you want to do is you want to have your positions. All right, so you're going to have your positions right here. I'm sorry if it's not the cutest thing ever, but your positions. In this case, we're going to have two distinct positions. Okay? Two distinct positions. We're going to have the first one, which is buy a put at $38. Then we're going to have essentially sell put at $22 two times. Okay, twice. And then at the bottom, we're going to write our payoff. Okay, so at the bottom, we're going to have our payoff. That's the first step. You just want to write your positions. Okay, that's really, the only thing you got to do. Then after that, it's just about figuring out which values are we going to assess what our payoff will be. Okay, so this will make sense in like 2 seconds, but it's still kind of important to understand my methodology. The first thing you want to do is you want to highlight all of the different prices given in the question. Okay. In this case, they gave you a price of $28, they gave you a price of $38, and they gave you a price of $22. That's like awesome stuff. Okay. That's pretty important. So these 3 points, you're for sure going to put them into your table. However, I would go so far and I would add 2 more points. Okay. You would add a point that has $0. By the way, I'll tell you in a second. It'll make sense in a second, so no worries. And then I would probably add a point that would be at like $76-ish. The second point that you add, the second extreme, it could be one of 2 things. Okay. And before I lose you guys, I'm gonna do this. So right here on your columns, you're gonna have different columns. Right now we've identified all of our rows, which is our positions, right? We had our put at $38. We had sell puts at $22 each. Then we had our payoff at the bottom. On your rows, you're gonna have your stock prices. You're gonna have like some stock prices. You're gonna have different stock prices because we want to assess the best place at which your payoff will be maximized, at which your payoff will be the greatest. Now, the thing is that students typically struggle with the idea of what stock prices should I include within my payoff diagram to maximize time and to actually yield the best results. In this case, what we've done is we highlighted 3 prices in red, which was the currently trading price, the $38 price, the $22 price. I would also recommend adding $0 and then adding another extreme. Okay. I would recommend finding your extreme by doing one of 2 things. Okay. How to find upper bound. There are 2 methods. Okay. The first method is simple. You're just going to add the prices given to you. 38 plus 22. Or you could simply just do 38 times 2. In other words, here we took our biggest amount and we multiplied by 2. Here we took our 2 positions. So I guess the sum of positions. Okay. You'll understand as we do more questions, you'll see why this is relevant. Right now, I'm kind of just throwing spaghetti on the wall just to give you max exposure on all things needed. Okay. So that said, we could actually go ahead and plug this in within our table. So we know that we're going to have $0 here. We know we're going to put our $22 here. We know we're going to put our $28 here. We're going to have our $38 here. Then we're going to add our, I'm going to go with the 38 plus 22 one, which is going to give us 60. Okay. So now we're going to we have all of our different columns. Alrighty. This is us building a payoff table, which is needed for your exam. Okay, it's pretty awesome stuff. So now it's about actually solving this and actually getting an answer. So let me ask you this. Let's use our visualization technique that we used like just literally 2 seconds ago. If we have a put option, okay, so we have the right to sell at $38. But the stock price of Apple, so we can even write Apple here. Apple's stock price is trading at $0. Will you sell at $0 or will you sell at $38? What do you think? What would you do? You would sell at 38. And if the stock price is $0, how much total payoff did you make on that single move? You can write it again if you want in the chat because it's the same thing. Exactly. So you made $38. Okay. What if it's 22 bucks? You could sell at $38 instead of 22. How much is a total payoff in that case? Kennedy, you're on a roll, so you could just put it in the chat. It's 22 bucks, the price of Apple on the market, but you are able to sell it at 38 bucks. So what is your payoff in that case? 16. There you go. If it's $28 on the market and you can sell it at 38, what is your payoff? 28 and 38. It's not 38 and 38, my bad. Yeah, 10. There you go. And then if it's $38 and $38, how much payoff would we have? 0. And then if it's $60, how much payoff do we have? Are we really going to sell at 38? Exactly. So now we have all of our payoff depending, exactly, killed it, nice. You won't sell, exactly. So now we have everything that we need for the first position. Now we need to look at the second position, okay? So which is selling a put at $22, okay? Twice. It's interesting. So let's just look at one instance of this. So let's say we had a put at $22, okay? And the price on the market is $0. What would be our payoff? What would be our payoff if it's $0 and we have a put at $22? What would it be? But like, let's just act like we were still in the first position. Let's just have a conversation. Let's say we have a put. We're just going to look at the put in itself. Okay. Let's look at the put in itself. If we have a put at 22 bucks and the price on the market is $0, that means that we could sell at $22 while the price on the market is $0. What would be your total payoff? Just like look at it from that perspective to begin with. What would it be? It would be 22 bucks. Okay, that's interesting. Now we have two puts. So it would be 44 bucks. As you said in the chat, that's amazing. However, we don't have those puts anymore. We sold them. We lost the opportunity to make that money. It's no longer ours. So our potential payoff is gone. So as Kennedy said in the chat, you're awesome, amazing. Yes, it is minus $44. Because we have lost the opportunity to make 44 bucks. Very, very, very well done. MJ, is that clear? Instead of it being 0, it's going to be minus because we lost the opportunity to make that money. Okay. So obviously, if it's $0, I mean, if it's 22 bucks on the market and you're selling your put at 22, all of these would be 0. Okay. It's pretty straightforward. All right. So it's very funny here. Okay, cool. So now what we need to do is we need to find our payoff. Our payoff is simple. You just add all of these together. You just add all of them together. So what's 38 plus minus 44? What is 38? Is it actually that? No, it's minus 6. Yeah, it's minus 6. Unless I can't do math. Yeah. Okay. And then here we would have 16. And here we would have 10. And here we would have 0. Here we would have 0. So obviously, it seems like the highest point, right? The highest point for our, essentially our payoff happens when the stock price is $22. That would be the best, position, the best event, the best place to be at when Apple stocks is trading at 22 and we would buy and sell our positions. Okay, that's when we have the highest payoff. That's amazing. Okay, now we need to compute this idea of profit and losses. Okay, we need to compute this idea of profit and losses. It's very easy at this point. All that you have to do is you really just have to look at this instance here. And we know that I'll write it here. So we have two positions. We have position A and we have position B. Okay. At position A, we bought a call at a $2.5 premium. So this means that we had to pay $2.5. Okay. But also, what's really awesome would be is that we sold, I mean, this is a put, my bad. We sold a put 2 times, so 2 puts at a $1 premium, such that somebody purchased these options from us at a $1 premium each. So we made $2 from the sale. Okay. So if we want to compute our profit, all that you have to do is do payoff, okay, plus premium earned minus premium paid. So in this case, we purchased a put option with a $2.5 premium. So we had to pay for that. But we also sold at B 2 puts at a $1 premium. So we earned $1 twice from the person who bought it from us. So in other words, I'll put it in blue just to make it kind of like different. And I'll put it here. In other words, we would have $16 as our premium, plus how much and minus how much? Can somebody tell me? So 16 plus what? Somebody write in the chat. Look at A and look at B. It would be $16 to find our profit, to find how much total money we made. $16 plus the premium that we earned. How much did we earn in premiums? Can somebody tell me in the chat? It should be like almost obvious. 2 times a $1 premium. And there's no wrong answer. Just put something in the chat. Exactly. Thank you so much, MJ. So we earned $2 from the sale of our 2 put options right here. And then you killed it. Thank you so much. Exactly. Such that, what is our total profit? If it's 16 plus 2 minus 2.5, what is our total profit? Exactly. Amazing. All right, so that's our total profit. Okay. Now, the reason why I love this question is because it's, for some reason, it's like daunting for students. And I get that because I was there and I didn't love it too. But if you take this simple approach to the question, I feel like this is pretty straightforward. Like, let's say you saw this on the exam, would you know what to do? Like real talk, because this is as hard as it gets. This question is as hard as it gets. Like, it doesn't get any more complicated than this. Would you know what to do if you saw this on the exam? I feel like it's a yeah. Like, of course, it's the first time we did it together. We're gonna do another one because we still have time. But like, I feel like we're okay. Anyways, when you review, you'll let me know. Huh. My phone screen just broke on me. That's crazy. Huh. That happens to the best of us, I guess. But yeah, cool. So let's do another one. That's so strange. My phone literally just broke on me right now. That's crazy. But anywho, let's move on to another one. Is there another one that I would like to do? I'm just finding one that's like pretty good. It won't be too long. Yeah, let's do this one. Actually, no, it's the same one. We'll do this one. We'll do one with no profits, just one that's quick. So let's kind of like do it together. So Jake and Sarah are interested in speculating on Nestle stock. So we're going to look at Nestle, and it's currently trading at $50 per share. And they want to build a portfolio with these three positions, which is buy a call option with a strike price of $45, sell two call options with a strike price of $60, and then buy a call option with a strike price of 75. So once again, we're pros at this point. This is light work. We're not going to do a payoff diagram because we want to be efficient on time. We're going to do a payoff table, which is essentially the same thing. So at this point, you're a seasoned vet. You know exactly what to do. We're just going to use a payoff table in which we're going to have our positions. We're going to have these three right here. Okay. And then once again, y'all remember the technique we take here. We identify all the prices, okay? We identify all prices one by one. And then in this case, I would probably maybe add obviously our zero, our extreme. Then I would add another extreme, probably like the sum of these two, or like the sum of these two. You just want to like an upper bound. So it could be anything. It could even be $80. Could be, but in this case, I'm gonna go with 95. Okay. So really, I don't know if this is too ambiguous, but this idea of an upper bound is simply just to have like a sense check. Okay. It doesn't always like do anything, but it's good to just visualize in case that you're like really nonchalant, as we would say in French. Okay. So we're just gonna write that down. We're gonna have zero. We're gonna have just gonna go with zero. We're gonna have 45. We're gonna have 50. We're gonna have 60. Then 75. Then we could add, and we'll go with 95. All right, so we have all of our different positions here. I mean, prices that we could have. And by the way, if you're already like ahead, don't hesitate to just plug in your answers. I'm just trying to make this cute so other students and yourself afterwards, when you look at this, you won't be like confused. I feel like that's always, you know, a duty of mine. And then we have our three positions, which is one, buy a call at $60. Is it buy a call? Yeah, it is. Then it's sell two calls. By the way, my bad. I'm capping. This is 45. Sorry about that. Buy a call at 45, sell two calls at 60, and then buy a call at 75. So this one's fun because really it gets you working your mind a little bit. And then we're gonna have our payoff. Okay, so classic game. If we have a call option, all right, and it's $45, and the stock market right now for Nestle, this is Nestle prices. Okay, if Nestle is trading for $0, but you have the right to buy for $45, what are you gonna do? Are you gonna buy it at $45 or are you gonna buy it at $0? Somebody tell me in the chat. What are you gonna do? Que vas-tu faire? Nande shiteru no ka. Something like that. I know we're almost done, by the way. We got 10 minutes. I need all of the excitement, as cringe as I am, all of the excitement that you got. One last sprint. We're almost like 9 minutes, okay? And we're done. This could be the last question if you want. All right? So I'm gonna ask you this one more time. If we're buying a call option at $45, okay, that's the exercise price. And the stock market, I mean, the Nestle stock price is $0. Are you gonna use the call option or are you gonna buy it at $0? What are you gonna do? Somebody tell me in the chat. What is gonna be? Yeah, there you go, $0. So your payoff is $0, okay? And if the stock price is $45, and your call option is $45. What is your payoff? Is it 10, 0, a million? What is it? MJ, we got this. Okay, cool. What about $50? What is your payoff? $5. What about 60? You got this. We're going through this together. 1.5. 1.5. 1.5. Yeah. Okay. I got scared for a little bit, man. Oh, actually, yeah, 1.5. And then what about 75? 75. 45 and 75. 75 minus 45. I feel like that's 30. Is it 30? I feel like it's 30. It is 30. I'm just having fun with it, man. And then we have 50. Quick, like, sense check. This is going to be our payoff for this specific position. Okay. But now, that's facts. But now we have to sell 2 call options. Okay, at $60. Now my technique is to just look at 1 call as if we had it, then look at 2 calls, and then look at the opportunity cost. Look at if we sold it. So obviously, if we have 1 call at $60 and the price is $0 on the market, we're not going to use it. At $45, we're not going to use it. At $50, we're not going to use it. And at $60, it still won't do us any good. Now let's look at $75, right? If the stock price for Nestle is $75 and our call option is $60, that means that we have the right to buy it at $60. Okay, that means that our payoff for 1 individual call like this would have been how much? Just for 1 individual, it would have been 15. What about for 2? How much? 30. But since we don't have it, what is it going to be our thing here? Since we know we sold it, so it's not our money anymore. We lost the opportunity to have it. You did the same mistake before, man. There you go. Perfect, amazing. Minus 30. Hell yeah. What about 95? Okay, what would it be? So 1 would have been $35. 2 would have been $70. Okay, so then we were going to have what as our input here? Nice, amazing. Minus 70. Okay, now for a purchase of a call, obviously 0. And then here it would be how much, MJ, for this one? 20. Amazing. Cool. We're like doing amazing. So our total payoff here would be 0. Our total payoff here would be 0. Our total payoff here would be 5. Our total payoff here would be 15. Total payoff here would be 0. And our total payoff here would be 0. So what is our total payoff? Like the best payoff in this question, MJ? What do you think? What do you got? What would it be? What would be the best payoff? Where would it be? There you go. And that's your answer. I want to hear from y'all. Like, is this not the easiest thing ever? Like, is this not the most free, like 5% in your life? Like, yeah, if I were you, I sit this on the exam, I'm laughing. I'm done in like 2 minutes. This is a very easy question to do. Do y'all feel the same way? Is it okay? If you see this on the exam, do you know what to do? Do you know the steps to follow? How are we feeling? ¿Cómo estás? Genki desu ka? Practicing Japanese right now. Like, for sure, the chapters, theoretical questions could be difficult, but typically on the exam, it's really going to rely on you using my little factors affecting option prices. That's all you need to do. Okay, use that. You're maximizing your utility, and then just this is all you need to do for practicing these questions. And I have like 8 of them. Trust me, you do all of them, you're guaranteed not making a mistake on payoff tables and profits. There's like no chance if you do all of them. Like, I would bet, I don't know if I'd bet my life because you never know, but still, you know, I'm pretty darn confident. Like, I could be pretty darn confident. I feel like y'all should have this. And with that said, okay, that's the end of our session. That's the end of a pretty decent session. I feel like we made some pretty good headway into topics. I feel like we did okay. I feel like you've had some decent exposure. And this is only a portion of what we'll see on the final mock exams, right? We're gonna have 3 of these, where we're gonna be looking at 8 to 12 questions per mock exam. So you're gonna see between 24 to 36 high level, very difficult exam questions. And I will probably send out more stuff for free just to help y'all out, to make sure that you're, I don't want this to be like a step back for any of y'all. So That said, I'm gonna go play some basketball, go eat some food, and I'm gonna relax. And I'm gonna see y'all on Tuesday. Hopefully this was helpful. Recording is gonna be posted in a bit. Solutions will be posted immediately. Okay? See you guys on Tuesday. Hopefully you have an amazing evening. Ciao, ciao.